Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is Andrew Papageorgiou, Managing Director of Realm Investment House and overseeing $2 billion of investor money. During our conversation today, we discuss the Evergrande collapse, shadow banking. We talk about the impact on Australia and for Australian investors. And we talk about why investing is so personal and not a one-size-fits-all proposition. I hope you enjoy my conversation. Let's get into it. Andrew Papageorgiou, welcome back to Masters in Investing. It's good to see you, man.
It's good to see you too, Rob.
Hey, the first things first, the China Evergrande group is on everyone's, it's coming out of everyone's mouths at the moment. The headlines are everywhere. I feel like the financial markets have not, there hasn't been much going on and financial media hasn't had much to report on. And so when we see an event such as this, everyone's grabbing it and everyone's writing about it. You know, I wrote the other day that I thought 99.5% of investors never heard of the company. All of a sudden, 2 days later, everybody's an expert on it. Yep. And so I think what that is causing, Andrew, is concerns and questions around what implications that has globally and what implications that probably has more specifically to the Australian market, the Australian property market, given our nexus with China, and what that means for investors and so forth. So if I can maybe just hand over to you, Andrew, to give us a rundown of your interpretation of events that have unfolded, but then also talk about contagion and what that means for Australian investors, if at all, if it has any implication at all.
Yeah, look, it's one of those things where it's one of those topics that you can really go down the rabbit hole on, right? Because there's two questions there. In the first instance, it's a question of what does Evergrande mean in terms of how does a default feed back into the systemic infrastructure, right? What does it mean for banks over there? What does it mean for banks over here? What does it mean for financial markets and so on and so forth? But the other question is what does it actually mean at a grassroots level? How did it happen? That's probably a question that doesn't get asked often enough. How does something like this occur, and why does it occur, and what is it symptomatic of? So when you talk about the first question of what does it mean for financial markets, the People's Bank of China, like every other central bank on earth, have become very well versed on what the playbook looks like when stuff goes wrong. So you don't see a Lehman Brothers type scenario. We don't see a Lehman Brothers type scenario developing because the favor the past gives you is a roadmap to new mistakes, right? So you generally cover off the stuff you shouldn't do because someone else did it last time and it really didn't work. And God knows we're not going to actually create a systemic event, just for the sake of it. But by the same token, when you do bail things out and you smooth things over, you potentially create bigger imbalances further down or further into the future. So while Evergrande doesn't necessarily pose a systemic threat, despite the absolute enormous numbers, right? And I think let's just pause for a second and appreciate the gravity of what $400 billion of debt actually means, even to China. Okay, let's not think that China can just absorb, or its banking system can absorb a hit like that and that's all fine and there's no problem. These are big numbers. These are big numbers. The fact is that the composition of that debt is different from what we would understand over here. So there are all these alternative ways of financing there in China, and you've got a shadow banking market which is enormous. Trillions of dollars big. We're not. When you sort of think about what are shadow banks in the Australian context, so we can compare. Fund managers are kind of shadow banks, right? Like the old mortgage funds were kind of shadow banks. This is a multi-trillion-dollar industry over there. There was $500 billion in what are known as commercial linked notes or commercial paper issued in China last year. And what's more, the way it's issued is a little bit freer than it is over here, right? Like the companies can issue that commercial paper, and until recently, they haven't actually needed to report on how much commercial paper they're issuing. So, you might have 400, 500 billion of liabilities there. You might have 80 billion of US dollar bonds where people look at that and go, oh, that's not that bad. You could do something with that. There might be some bank loans there as well. But then there's, 200 or 300 billion or 400 billion of these credit notes, right? Or commercial paper, as they call it over there, where, or it might be 600 billion. It could be 700 billion. You don't know.
Yeah.
Right. You don't know, but, and this commercial paper they can hand that out. Like they need steel they need to pay their steel supplier. They might actually pay commercial paper or compensate them through commercial paper. And then those guys can sell that on a market at a slight discount. So it kind of works like factoring or invoice financing, so you can pay suppliers in this stuff. You can pay other obligors with this stuff. So, what you end up with is, you end up with this very large shadow sector that's not connected to mainline banking in a very, very clear fashion. It's almost indirect, So how's it sort of connected? Well, the senior banks will provide, they'll provide some unsecured liabilities to one of the various companies that of the Evergrande Group. They'll lend money secured on individual property developments, right, that have just stopped. But, as a bank, if it was in any other country and this place went under, the banks would look at it and go, okay, we'll take a loss here, but there'd be a haircut. It wouldn't be a 100% loss given default. The problem here is we're talking about China where, where seniority in credit stacks, and so it doesn't mean a thing. Because ultimately you're dealing with a regime that's first priority is just maintaining control and keeping the populace happy. So, they've already said that they're going to look to ensure that people that have paid for property get their apartments, so that they'll bring developments, or they'll look to bring developments to completion. They'll probably look to protect suppliers and investors that are holding wealth management products. So just to give you an indication, Evergrande turned around and made their 120,000 odd staff invest commercial paper into their organisation late last year, early this year. Like people in China where the wages aren't particularly high were writing checks for 20, 30, 50, 60 grand, depending on how senior you were. And now those guys are all pissed off as well, right? So you got all those people, and you've got this US dollar bond market, which frankly is no longer a priority because we're clearly not particularly worried about what foreign capital markets think about us now if we're Chinese, because we're we've cut this industry down at the knees, and those equities are gone, and casinos gone there, and if it's bad luck, if it hurt your feelings, it's bad luck for you guys. You're starting to realize what you're dealing with, and the things have changed. 2 years ago, all the investment banks were holding seminars to help us all understand around the opportunity to invest in Chinese debt and the US dollar Chinese bond market. And look, let's be honest, it's ended up where it was always going to end up. It was
But Andrew, that's the thing, right? Like, since the GFC, China's been hot and everyone's been running seminars on why you have to invest in China. And I always think about, like, if you're driving a fast car down the road of a really windy road and you've been drinking in the form of leverage, like, what do you think is going to happen? And inevitably, like you say, this has happened. Maybe
that's not where I'm sort of going though, because the thing is that would be under a normal capitalist argument, what you would say would make sense, but they don't give a stuff about capitalist outcomes. It's only to a point. Ultimately, the key objective here is control. So, even if you're talking about state-owned enterprises, you look, I remember investing in Chinese utility stocks back in 07, 08, and you could never understand why Chinese utilities traded on a P of 1 time or 2 times. It wasn't until the Chinese government forced them to, generate and supply power at a loss for the next 5 years that kind of made sense. So that's the agenda. They don't really give us stuff about your outcomes, and it's not just normal market realities that are stuffing with you. It's, the system is kind of rigged, right? So, when they sit there and someone's got to take it in the neck, your US dollar bond market, your US dollar bond investors, which are private bank customers out of Asian private banks, some onshore, you've got to eat it, right? But the story is even worse, really, when you actually dig down into why these guys are as heavily leveraged as they are, And, like even your triple B minus property developers over there, like your Shimao and Countrywide, which are names you wouldn't have heard of right now, which are your good names, their levels of leverage are enormous. And these guys
enormous
are all,
relative globally, Andrew.
Enormous. Normal, like if you were to look at what does an A-grade development company look like over here in Australia? Look, let's say Lendlease is probably your atypical development type business. There's no comparison in terms of how these businesses look next to each other, the level of gearing, and when you take into account commercial paper and how that's used as well. And what you've got these guys essentially needing to develop and needing to keep the cash moving because they're like a shark. If they stop swimming, they're going straight to the bottom, right? So, what you've got these land releases that occur in these second-tier cities and third-tier cities. They're really heavily contested because these guys need to win those land parcels so they can develop, so they can keep the money flowing in. And, the reality is that you've probably got a reasonable sector in size because we're talking a really big part of the Chinese economy here. So steel production globally, 49% of it's in China. 30 to 40% of that might go to real estate. 60% of it might go to construction. So then if you lose that mechanism as well, those local government authorities, when they release land parcels, that actually raises money that you could then put to work from a fiscal standpoint. And that's how they pushed back on a market that was in trouble in 2010 and 2016. So look, they'll find a way because, they are they're the banker, they're the thimble, they're the horse rider, and they're the car at Monopoly. They're the only game in time. So funnily enough, the numbers will somehow fit, right? But at the end of the day, what it does is sort of calls into question their ability to maintain their growth levels within areas like their real estate, the real estate sector. And it does provide challenges for growth. Does it create the risk of an imminent crash? No. The reality is that these tier 2 cities need to be built out because there's no more space in those tier 1 cities, and there is still a migration to cities, and all of that stuff keeps running. But what the Chinese are saying very, very clearly to Western investors is that we're going to get it done. We don't give a stuff about the economics, and we don't really care about what you want. We're going to get it done. We want these people being able to afford apartments. We want them to be able to move to cities. We want to be able to assist in capital formation from that perspective. And if you guys want to play a part, that's great, but no guarantees. And don't look at the rules that you guys have become accustomed to from a Western standpoint. One of the narratives with Evergrande, for example, is the leader, the CEO of Evergrande is also a very senior member of a faction within the Chinese Communist Party that isn't particularly well thought of or regarded by Xi Jinping. So, there's also the potential that, he's found a good opportunity to take the hobble chain to one of his main political competitors at a time where he's about to enter into his very controversial third term. And then you've got stuff off the back of it where you've got these guys spending a lot of money to consolidate the geopolitical position through Belt and Road and stuff like that as well. There's, it's big, it's complex, it has a lot of limbs, and it almost certainly has an impact because it will affect the amount of cash that they can generate for fiscal purposes by limiting land sales. And it is a big part of the economy. It will affect sentiment, certainly real estate investor sentiment. And then, it's a pretty straight line from there in terms of what it means to us, which is where your question sort of started. Like, what does it mean to us? It means that, it probably means those iron ore numbers that everyone sort of put forward last year are probably more likely to be achieved now. Even though iron ore's come back a long way, you've got a lot of iron ore miners out there with break-even prices of $80, $90 a ton where they've been making great money, right? But that might be a loss-making mine sooner rather than later. And then what does that mean for everyone that's high up on the cost curve in these commodities? What does it mean for the mining services businesses that support them? What does it mean for explosives businesses that also are simultaneously exposed to
it's just a domino effect there,
prices. Right? Yeah, but look, it's not, there's no crack, there's no single event, there's no, and when you sort of think about GFC and you think about all these other things, there are always things that drove convergence of the problem where it could overwhelm the firewalls, right? But there's nothing seemingly that makes that happen. But let's not kid ourselves into thinking that it's all okay. It's not okay. It hasn't been okay for a very, very long time over there. And the debt levels are enormous. Their banking system is about, whatever it is, 50 trillion in debt versus a US banking system of 25, right? These are really big numbers.
Yeah, you're absolutely right. It is big numbers. And I don't know if you know, but I'd be curious, since the company IPO'd in 2009, and since then, nothing's really happened until 2016. I think the stock went from like five Hong Kong dollars to like 300 at its peak. And literally in a matter of months, it's a vertical rising price. And then there's a whole bunch of volatility there, and it's literally collapsed back to where it was prior to its rise. What was it? Do you have any idea as to what drove the company to be so valuable during that time? Was it?
Yeah.
Was
so think about 2016. If you remember the narrative in earlier 2016, it was that Chinese hard landing that everyone was really worried about, right? And then what you got is a lot of fiscal expenditure that essentially supported the Chinese economy, and that sort of fed into construction. And look, I wouldn't be looking at the price today and say, oh, it's just come back to those levels. This company is as broke as a joke, and then some. Right, like there's nothing there. It's very different being where they were versus where they are right now. Look, I'd say to you that people might hold it or expect that some parts of the business sort of get held together for the greater good. At the end of the day, there's nothing to say that the People's Bank doesn't own a good portion of it already. Right. So, the ability for debt to equity exchanges also has a precedent within China, where lenders have been asked in the past to essentially exchange their debt for a portion of equity in a clean business. So, there are a lot of, and the other part of it is that if it was any other company on earth, you'd go, your LGD is 100% is going to be very high on debt. If US bondholders are taking 70 or 80 cents in the dollar haircuts, how is it that you have an equity value? You can't, right? Like that doesn't make sense, but it makes sense in China. So go figure that one out.
And does the company, Andrew, all the development that they're doing, they've got a number of different sites, a number of different projects, and these projects are mind-bogglingly enormous projects. Yeah. Does the company own the land that these developments are being done on? So if you think about a Lehman Brothers, if you think about an investment bank that may have a lot of on paper balance sheet and these intangible assets, where if you've got a property development company that has something that is of value, if I can call it that, is that true?
Yeah, they land bank, so they buy the land. They actually physically buy the land and they hold it on sheet, right? And but the like most developers, like if you look at an Australian development company, for example, what you find is our industry, our LPT sector in particular, has come a long way. So generally, what you'll have is those companies will have a nice funds management component that provides them with a nice annuity. It allows them to actually bring in outside or third-party capital to get developments done, and it helps almost hardwire the development profit. They might hold a bit of the profit in the actual existing asset. Then they'll have some standalone property assets in their own right, and then they'll have a development book as well. With these guys here, they want to maximise their return on invested capital. And look, when things are running hot, property development will give you a higher return on invested capital than these other things. Okay, and that's why people go into it. That's why they do it, and they give you super high margins where you don't even have to hold any of your own money in it, because you're issuing commercial paper, which essentially provides you your MES or the equity within the developments as well. So look, I think development margins there in China were close to 30% at the turn of the 2010s, and I still think they're, my understanding is that they're within 15 to 20% even now. So the development margins aren't bad per se, but where, like, dare I say it, I mean, we're talking about I won't actually know. I mean, it borders on being a kleptocracy, right? Because essentially the level in any environment there where it's a controlled type of economy, the inefficiency is going to come in the form of graft corruption, and it creates enormous inefficiency where money just goes missing, right? And that's what the Soviets figured out. Okay, and the lesson for the Chinese was that capitalism did have a positive role to play in terms of efficiently allocating human capital and investment capital, right? So that was the thing that could offset, the negative learning or the learnings from the Soviet system. But as we can see, that the inefficiencies are still significant, and I mean, you can't churn out a billionaire every other day unless someone's doing something, right? Let's be honest.
No, that's right. Now, my understanding is also the company beyond its land development and real estate development. I mean, first of all, you used Lendlease as an example. I mean, if you look at an Australian company like Lendlease, relatively speaking, it's a pretty clean company in terms of its structure, the way it's set up, etc. Whereas my understanding is, if you look at Lehman Brothers, I mean, Lehman Brothers was just one mind-boggling corporate entity to even unfold and understand and unpack what the damn thing even held and how it operated, let alone to try and understand how this thing operates. My understanding is that the company owns soccer teams and a whole bunch of other things within that. And I think that might come to the surprise of a lot of people, but I think it just goes to show the complexity of the company, its operations, and in fact, then what the unintended consequences are of whatever ends up being the decision that's made.
It's not as strange as you think, right? Again, you're sort of using a Western form of thought in terms of understanding it. At the end of the day, you know what? The Cali cartel had a soccer team, and so did Pablo Escobar as well, right? Because it becomes a public relations vehicle, and then in terms of EVs, you look at electric vehicles, the Chinese government put an enormous amount of subsidy in that space, right?
100%,
so these guys,
absolutely right.
They're not idiots. They saw free money there. So, they opened the front there. And the whole process towards that almost becoming conglomerates is something that's quite common in Asia, actually. You see it very often in places like Korea as well, and in Japan for that matter too. So, certainly in the case of all banks, not just Lehman Brothers, but a lot of European banks, the stuff that ended up on balance sheet would make, most people absolutely, wonder who was watching and, who was making up the rules and who was enforcing them. But, we've had the Basel continuum come through since, and bank regulation and bank capital levels and, the safety of bank balance sheets in the Western world is, they're as strong as they've ever been, is the reality, right? Certainly not the case in the Wild West or in China.
And so where the way investors are looking at it here, as we sit onshore, if you like, you explained before about the potential implications with commodity prices and the domino effect that has on those that aid the mining process, for example. But what impact that may have on our economy and on federal balance sheets and so forth. The everyday investor, Andrew, how concerned should the everyday investor be as it relates to their investment and their portfolio? Maybe if you look at it from an equity perspective, but also from a debt perspective, is there an impact? Should these people be worried?
It has an impact. Does it crash everything? Probably not. Does it actually create another source of tension in an environment that's almost priced to perfection? Right, where you're buying best case outcomes in credit, you're buying best case outcomes in equity. It's one more fly, it's one more thing you're swatting at, right? I mean, it's definitely negative for growth, right? And more to the point, we talked about Evergrande and what it might mean for this and that, but look, arguably AUKUS does just as much damage to Asian investor demand in Australian real estate. The demand for education from Chinese students. There's this stuff as well. Because again, they're a command and control economy. At the end of the day, they're not playing by your rules. So that's where you have to sort of watch the ball with that stuff. It's sort of, look, the numbers, it just peels away at the numbers, right? So all of a sudden allow for that. Bring back my BHP, my Rio estimates, my Min Resources, my Emeco. All right, now what's my ASX 200 target? Well, I'll take a little bit off now. And did you consider that, you're going to see an impact on student numbers because the Chinese are really unhappy around the nuclear submarine deal? All right, well, we have to allow for that. So take, and this stuff mounts up. That's all I'm saying, right? So, and that's okay if you own a market or you own an asset which is priced. And we talked about this last time, I think, in your podcast there around, thinking probabilistically. So if all of a sudden, if you're buying a market that just tells you everything's fine, everything's perfect, and you're accepting that price, well, then, as stuff starts to go wrong around it, you're arguably now not being compensated for the risk.
Is that what not the bond market's saying, Andrew, that we haven't seen CDSs blow out at all with any of the major US banks, for example, in light of the Evergrande event?
Yeah, look, the transmission to the real system, as I said earlier, is low, right? Bank of China's CDS is higher. Chinese sovereign CDS is higher, right? So it's not that there's been no effect, but look, the reality is that, the American banks and Australian banks, they're probably reasonably well protected from a direct hit, notwithstanding that asset performance for certain borrowers might struggle for a period of time. I mean, we're not talking about this potentially being existential for these guys, but for some industries, they're very, very serious headwinds. So US, the CDS of JP Morgan reflects that, that it's that fly that you're dealing with. What does it do? Well, you know what? It might impact your Chinese GDP estimates, which impact your global GDP estimates, which flow through to, oil price assumptions, copper, blah, 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 that might impact your lending limits to certain industries and sectors and so on and so forth. Yeah.
The sense that I get from you and what I'm hearing is that there are absolutely ripple effects, but is it safe to say that someone like a JP Morgan or a US investment bank or even companies here in Australia are probably further out from where the stone hit the water, and there will be some of impact or effect, but it's much smaller than what it would be if you were much closer to the issue, like the People's Bank of China, for example. You mentioned CDS blowing out. The fact that we're so much further away and insulated, that there may be some impact, but it doesn't sound like it's something that investors should be too worried about.
Well, look, if you had seaside property during the Fukushima earthquake, it was a much bigger problem than you were in, if you lived 30 kilometers inland, but you still can't drink the water for about 100 years, right? So, look, what do you want me to tell you? The reality is that it's an issue, like you're not really close if you're an iron ore miner with a 95 break-even price.
Sure.
You feel like you're a long way away, but you know what? You're in trouble now.
Yeah. I'm more referring to the end investors,
There's no big bang. I think if that's what you're alluding to, there's no
that's right.
systemic event that snaps things, but it's not a small headwind either. I wouldn't want to be reductive around the risk either and say, there's nothing to be concerned about here, because we're talking about, when we're talking about global economic growth, China in US dollar GDP terms might still be smaller than the United States, but when you look at the nature of its economy, it does have a much bigger multiplier effect in terms of how it flows through the rest of Southeast Asia. So, it's a big lever. It's a big part of that global economic growth, and it does have the ability to have a reasonably meaningful impact, which could impact on your view around bond yields, for example, and commodity prices. And when we start talking about all that stuff, it's in everything at that stage, right? So, but yeah, no direct hit to the Monty Python parlance would be, 'tis but a flesh wound, right?
The comment you made before about the impact that, if you've got the tally of what are pros and what are cons on in developing your, forecast expected returns and risk and so forth. You talk about migration and students. My understanding that the likes of what Evergrande are developing and the impact that has on the economics as it relates to those that reside in China. And look, I don't know the exact breakdown of those that come to Australia and who is educated here and who buys property here. I suspect, though, and happy to stand corrected on this one, is that the folk that are buying property from Evergrande are not the people that are coming here to buy property on the harbour in Sydney or in Melbourne or sending their students here to be educated. It's a very different group of people.
They're more entitled minions and party members than the ones that have to stay there, but they're party members nonetheless. they couldn't figure out where Jack Ma was for like 3 months, right? And apparently he had taken up golf, or he was exploring his hobbies. I don't know if re-education camps would sort of count as golf academies or a fishing holiday. But these people, when they don't play ball, they go quiet, they go missing. And what it sort of shows you is, you've got all the levers are being pulled right now. Yeah, Evergrande might not be an issue for your property over here or your apartments and your developers. But let me put this to you. You've had them in the last week. They've turned around and they've spoken to the idea that virtual currencies like Bitcoin and digital currencies are illegal, and they take money outside the system. They've clamped down on their casino industry last year there, whereby they've got ATMs that require facial recognition, where for a long time Macau was sort of seen as the way that money got out.
That's right.
Okay. You've got the Americans going after Grigorievo, who's the head of the World Bank, and they're pushing the idea that the Chinese should not be able to actually take loans out of the World Bank as an emerging nation, because they're not anymore. And in fact, they're actually lending money to places like Zambia, who are then defaulting and they're stealing mines off them or taking mines off them and so on and so forth. So this is the environment is getting heavy. So I would ask you this: what if they don't let them pay the mortgage repayments on those apartments? What if they don't let them come? What if you're not allowed to remit funds to pay the interest expense on that apartment that you took through a non-resident program for agents? What if they just don't let you? Is it because are they going to stop because they're really worried about what Western capital markets might think? Well, they really clearly don't give a shit, with all respect, right? So, how much trust and faith do you want to show? And that's really what it comes down to. So, Evergrande might not be a problem, but what it speaks to around where China is and how things are transitioning and the geopolitical factors that relate to China and their relationship with the Western world, okay, and more specifically the Anglosphere, right? These are bigger questions, right? Like I stand by that, from an Australian perspective, AUKUS, okay, might have more financial ramifications for the average Australian than Evergrande, right? And that's not to say we shouldn't, because look, the fact that they act that the regime acts the way it acts just speaks to the idea that we should be looking at protecting ourselves, and we need to think about our economy and how durable and robust it is, right? But by the same token, I don't think you want to take those risks for granted or underestimate them. So you talked about the tally before. It's not necessarily about tallying. Sometimes you just look at an environment and you go, this is an environment now that, probabilistically speaking, is seeing its tails fatten. Right? So the uncertainty around outcomes are rising. When market prices are really high and strong, that is a market saying, I'm very certain. You look around you, the environment is saying things are not certain. There is a discrepancy between what the market is saying and what the normal distribution of potential outcomes would be saying. Okay, so the real risk probably exhibits a higher level of implied volatility than credit markets currently express, than equity markets currently express. That's not to say that the market prices can't be right. They just have a narrower channel at being right than would normally be the case. That's what we're saying.
Yeah, I think that's a really good way of putting it. And in fact, the things that we're going through now are probably more normal than the experiences we've had over since the GFC, the last 10 or 15 years. And I get the sense that if investors have become more accustomed to that experience, and so then when there's a glimpse of uncertainty, it's amplified because it's a new thing, and people almost feeling like this is not the way that this should be happening, because it hasn't happened like this for the last 10 or 15 we've talked about recency bias. If something hasn't happened, I mean, we haven't had a down 2 or 3% day in since COVID. And so market's been tracking up since then as well. If you strip COVID out, it's been 15 years before we've seen any real risk of defaults or anything like that. I mean, defaults happen every year. You've got $20, $30, $40 billion bond bond issuance default every single year. It doesn't get talked about, but I think the narrative around the China and how close we are and all of that, there's a lot more headlines going on. Maybe people are just bored that there's nothing else, not much else happening, that we've got a narrative to cling on to.
It's a big one. Look, the only thing I would say, just to challenge the statement I've made around the fattening of the tails as well, and just to speak to that comment you've made there around what's happened in the last 15 years, the central banks have absolutely come out of the shadows and have started to become explicit in the
you and I have talked about this numerous times.
Yeah. So one thing that does, when you sort of think about it in that form of that bell curve, and the tails are fat, but if you know that a central bank's going to stop the really bad thing happening as soon as it starts becoming even remotely likely, that would explain why the market feels more comfortable traveling that narrower channel, because even if all the the unknown unknowns are always there, but as these known negatives start to sort of rise up, I still have confidence that central banks are going to do what they need to do to stop it getting really, really bad. So this is the whole thing where people have now become well versed at buying the dip, because if it gets really bad for about a month or 2 months, you're likely to see a coordinated response from central banks all over the world to stop it being as bad, right? So that in fairness, that would probably be the contra argument to mine that the tails are fatter. So what are you doing? But I think regardless, it sort of speaks to the fact that it's a time for general caution. It's probably not a time where you're swinging for the fences.
Yeah. Look, I don't disagree with you, and I think if one's risk is being reduced by central banks' coordinated responses in the way you put it, if one's risk is being reduced because of that, then investors should expect lower expected returns. If you're not taking that level of risk, don't expect to be compensated like in the 05-06 years of insane returns. Yes, people have had insane returns from really low bottoms. We talk about COVID most recently, but in more normal course of events, whatever on earth that actually means, you just can't you can't expect to be compensated if you're not exposing yourself to that level of risk. I think it comes down to that. Andrew, can we just sort of, something that's been developing most recently, CBA came out, if we talk more onshore, CBA came out recently, their CEO talking about how hurdle rates need to be increased for borrowing and borrowing capacity. I think Josh Frydenberg came out recently and said that also needs to happen. APRA already talking about more closely governing what is lent to borrowers, because what we are seeing, and I'm sure you're seeing as well, is property prices start to jump significantly. You've got lending growth rising rapidly. Now, all of this has consequences, obviously, for an economy that appears to be on face value quite resilient and doing quite well, but not the stock market, but in the real economy, you've got businesses shutting down. You've got a lot of people who are unemployed, whose businesses are forced to be shut down, and people are relying on savings that have been accumulated by government handout and distributions. What can you maybe just talk through what you're seeing as it relates to the work that you do with lending, prices, borrowing capacity? I know we've talked about a lot of this, you and I, in the past, but I think now we're starting to see it get to a point where people are starting to get concerned. People are now questioning, well, not so much questioning, it's on the agenda now to start controlling this a little bit more than it had been in the past 3, 6, 9 or 12 months.
Yep. I mean, it's like real estate's had, obviously residential property prices have had a good year. I think, leaving the stats aside, as soon as, most people have an anecdotal example of some place in their the immediate vicinity of where they live sort of going up 40 or 50% as well, right? Which tends to colour us, because we then benchmark every other home in the street to that one home, and and look, it's reconciling with a market, a rental market that's particularly weak as well, And so what you're seeing in terms of the themes, and I think it's sort of been spoken to as well, that the interesting trend this time is it's owner occupiers doing the buying. In many cases, it's actually investors doing the selling. So it's very different from the previous occasions where people have gotten concerned because the concern coincided with a run-up in prices that were driven by an increase in interest-only lending and an increase in investor lending. And then, of course, what we had is the serviceability criteria came through a lot stronger, and you saw banks pull right back, and that coincided with some macro-prudential work as well around interest-only and investor lending as well, which really slowed things down. This time it's owner-occupiers, so it's different, so you can't necessarily use the mechanisms we've used from a macro-prudential standpoint here in Australia to slow it down immediately. You want to take some of the heat out of it. I mean, equally, some of the prices being achieved are eye-watering in some cases, but we're not necessarily seeing enormous amounts of stock change hands at these levels also, which is important to note. Nonetheless, if this was to become par for the course and people started to customarily indebt themselves to levels of 5 to 6 times their gross income, we're dealing with something that potentially increases the risk to the system, especially in a scenario where rates rise. Right. And I think what Matt Commons sort of spoken to and what the CBA have done, it speaks to the fact that Australians tend to, they sort of think of their household finances in terms of P&L rather than balance sheet, and that's a reasonable thing to occur when, the cost of borrowing essentially declines 5-fold or 6-fold, and, you're going to get more comfortable about holding a larger amount of debt because you know what it costs to service. But of course, what the bankers are looking at, what central planners are looking at are, what if inflation's not transitory? What if break-even cash rates aren't at 1.5? What if mortgage rates are at 5.5? Joe Bloggs over here has gone and borrowed $1 million to buy a place, and he's paying 25 in interest a year, and then he's having to pay 40 a year in principal. That's 65 post-tax. And now interest rates go up to 5.5, and now he's paying 115. And frankly, he doesn't earn that after tax, or she doesn't earn that after tax, or they don't earn that after tax. And bang, there you go. All of a sudden, it's a real problem, and it starts to crimp economic activity really, really quickly. So when you're sort of listening to economists now talking about break-even rates, cash rates being in the 1.5 type neighbourhood, what that's basically speaking to is that as soon as the rate goes above that, it will have it will actually
that's the problem. That's the problem area, isn't it?
Yeah. Well, it'll shrink the economy. If you want to slow things down, if you want to actually pump the brakes, cash goes above 1.5, and you're doing it. Well, what if you have to be at 3 because you're dealing with an inflation issue, and all of a sudden,
yes,
so the economy is slowing down in that type of scenario as well. So that's stagflation type scenario is a really scary one for an economy like ours, where household debt, even though it's slowed down for a while, is still reasonably low. Is still reasonably high, I should say. And it makes everyone vulnerable, especially the people that are acquiring homes. And most of these guys are, not most, there's a good proportion that are first home buyers as well, right? So is it alarm bell stuff? No, look, it's not alarm bell stuff, because while the numbers, compositionally, the numbers are big as a cohort. So if you looked at it as a 2021 vintage, and a 2022 vintage and a 2023 vintage, you could see how those vintages might have some issues because of the absolute level of debt. But when you mix that in with the rest of the mints of the 19, 18, 17 and so forth cohorts, well, then all of a sudden you've got a mix where the numbers matter, they impact things a bit, but in the aggregate, things are kind of okay, all right? But you've got to catch it early, because if you don't, things can sort of get away from you. So the idea that you use macro-prudential, it makes sense from the perspective that the feeling is that your break-even rates for the economy might be at 1 to 1.5. So you feel like you're sidelined in terms of being able to use monetary policy. But then what you also know is you've seen what's happened in the past with macro-prudential as well. It had a really significant impact on property prices.
Absolutely.
We know what happened in 16, 17 and 18,
yes.
And people like to blame the argument around negative gearing, and that might have had something to do with it, but it was this other stuff around serviceability and the other things that were going on that had just as big an impact.
No one's got negative gearing now, Andrew. Who's got negative gearing? Positive?
It's irrelevant. It's irrelevant, right? But, look, the other thing is, Phil, the RBA, they've talked about tax, like tax in the context of property might be CGT on owner-occupied residence, right? God forbid. It might be It might be CGT, removal of the CGT discount for investment property. Now, think about what that does to your internal rate of return. If that final cash flow, if that final cash flow gets cut in half, good luck, right? And then, there's other stuff they can do as well. I mean, dare I go after the sacred cow? And being of Greek descent, and
what's that?
Us Greeks love social security, right? But what if the entirety of the owner-occupied residence wasn't assets test and income test exempt, for argument's sake? I mean, if you're worried about affordability, if you're worried about sort of driving a transition from property of the older to the younger, all this stuff would have an impact. No one's going to go to an election with it because, like removing residential property from assets test or asset test exemption would be, a default death tax. So not only would older Australians hate it, but Generation Xers who are waiting to get their hands on that property, they wouldn't be too keen on it either, right? There are other things that can sort of happen in the background that have been mooted, but are probably very, very difficult from a political standpoint. Macro-pru, which, as it's known, is probably the effective middle way. The inclination seems to be to link it to income. The logic of linking it to income is that you cool down first home buyers because they tend to be starting off a lower base, right? Interestingly, you could also argue that maybe you can give them a bit more leeway because, if you're 21, 22, 23 buying your first property, I think it's likely 7 years later your income will probably be higher, right? So, you could argue that being really punitive on that cohort is maybe a bit unfair, right? Because they are at the bottom of their earnings trajectory, right? I think you could argue that, but certainly I think the income type levels or total leverage tests around income as a second qualifier. Now that serviceability, we've sort of come off. We were a bit less intense around serviceability. We've opened up, the spigot a little bit in terms of looking at expenses and what are you doing with Netflix, and we've stepped back a little bit there. So we're obviously letting a bit more out, but we need a secondary test, which is sensible, right? So we don't go too far. And its ability to just cool down that first home buyer market in the meantime as well probably makes a bit of sense. Look, it's flashing amber. It's green to amber. It's not amber to red. It's good to get it early, because these types of macro-pru measures, for them to work, if you go too far, they need to be really heavy-handed.
Yeah.
So if you go earlier and you just tweak, first-time buyers, they're off the chain a little bit. Let's cool them down a bit. Okay, things are sort of stabilised, and we go from there.
Yeah. Is that sort of your point of view, Andrew, going forward as lockdowns are slowly starting to open up, as private inspections are opening up, as I don't think you can do auctions, but online auctions, as we enter that world, number of properties hitting the market. I know a number of people that have bought properties, Andrew, before the lockdown, who are now geared up to the eyeballs because they couldn't sell the other property to contribute towards the acquisition of the new one. You're going to have a ton of property coming onto the market. Supply coupled with some restriction around, or some parameters, further restrictions around the way one can borrow, should have some stability or cooling of prices, or maybe I should say slower growth and not growing at the...
Look, that's an interesting statement. I don't know the stats really bear out that we're seeing a supply side response of, massive additional sales and whatever else. I think things clearly slowed down, especially here in Melbourne as we went into lockdown. But, look, I would imagine that I think the market's still orderly. I think it might have softened a little bit since we went in. And then again, we might be fine again by March next year where they're being bid again. But it's not. I don't think there's... it's always an uncomfortable position holding two properties, right? You feel every micro bump, but the reality is that the market's fine. The market's fine, and the supply side response hasn't been enormous yet. And what you've just talked about there, which is people trading up, I mean, that's an orderly property market, right? Like that's people selling theirs, taking some off the table, going further up, and it sort of tracks their point in life and their earnings, and that's fine. That's fine.
But also there are situations, and we're seeing it live, whereby people are downsizing, where, the boomers, where the kids have moved out and they've got a $3 or $4 million house or a $2 million, whatever the number is, and they are taking equity off the table. That's one of the reasonings. The second reason is they just don't need a big house.
Depends.
And
do you want the age pension?
oh well, to your point before about qualification and so on and so forth.
Let me ask you this: so you've got your 4 million property, you sell it, and because I'll defer to you. Not that from memory, I don't think you probably haven't had a social security client in 20 years, Rob, but I'll test you nonetheless for currency. So you've got someone.
I'm already going to say I don't know, man.
No, but here's the thing: like, what do you get for 3 million at the bank? You get zero, right?
Yeah, but you don't put it in the bank. Who puts it in the bank? Who puts $3 million in the bank? You know this better than anyone.
If it's in the house, you're going to get an age pension of like $30,000 a year.
Yeah, but I think this whole conversation we're having now is so personal to people that you and I could talk about all this stuff until the cows come home. But the reality is unless you then apply that conversation to someone's personal circumstances, it doesn't mean anything.
Are you saying not everyone wants to die in their house so they can hand it over to the next generation?
I don't know what I'm saying, actually. But we talk about Evergrande, we talk about BHP, we talk about Social Security. It all goes back to what do you want? What do you need? And
absolutely,
if someone can happily live on 30 grand a year in their $3 or $4 million house in Baldwin or in Malvern, then go for it, man. Do what you want, because you're probably going to get a much higher ROI on holding onto that property anyway. So do that. Don't take that off the balance sheet.
Yeah,
I don't know. I just think it's so personal.
Well, it's interesting. I think the idea that imagine you did assets test that property over $1 million.
Well, they did it with superannuation, right?
Yeah.
So you got $1.6 million cap. I mean, there you go. There's a precedent to apply it on your home, on your family home. $2 million family home, $1.5 million home, indexed at whatever rate you want to index it at. Sure. And the first 1.5 is tax-free. The rest is assets tested.
So if they do that, that answers your sort of question there, and it actually forces stock to move and then puts cash in hands, which goes into real economy and blah blah blah. So, look, I think it's been contemplated. I think if you read between lines from central planners and regulators, I think there's if you didn't have an electorate to worry about, it's probably something you would have done already, right?
It makes total sense. Imagine living in a $5 million home with no other assets and you're claiming the age pension.
Yeah. I won't. Meanwhile, if this podcast ever becomes public in Oakley, I won't be able to go back to the suburb I live in. But that's neither here nor there, Rob.
I think it's sensible. I think the government tried to do something by massaging a downsizer contribution rules, whereby if you sold your house, you lived in it for 10 years, you're over 65, you can put it into super, all these things. I don't think that was a motive for people to sell the house, quite frankly. I think that was just another win for those that had enough money and couldn't put money into super. I think the intention was there, but I don't think it really struck home or hit home as to where it was originally intended, unfortunately.
There was some intention there, right? Like, who knows?
Who knows? I don't know. Andrew, this is awesome, man. I always enjoy chatting with you. The thing that I take out of all of this is that the world is complex. The reality is that when you invest, the definition of risk is something happening that you just didn't think about. That's it. And we can sit here all day and talk about potential risks to the economy, our investments, and so on and so forth. But, no one predicted COVID. No one predicted Evergrande company doing in the position that they're in. There will always be something. And I feel like they're the rules to the game. If you want to be compensated with a higher expected return, you need to take on a level of risk. And part of that risk may be that the journey from where we are now to where you want to be is just going to be a rough ride. And to your point, you feel sort of every micro bump along the way. And to my point before about everything being so personal, don't have 100% of your money in stocks if you can't ride that ride.
Oh, look, I mean, that's very definitely your domain. But I think, it was interesting. Once upon a time, we used to wear the same hat, right? And I think the one thing that always stayed with me from my time in advising was, there's no such thing as a low risk investor in a hot market.
No, that's right. That's right.
But the reality is that's where it's in your hands. And that's where, look, our partners are, we're committed to this sort of financial advisory space, because we think that the prescription of financial products should be done by financial advisors that can actually bring people into scope, and things like life expectancy, where you are at your point of life, and actually really forcing those difficult conversations where sometimes they may not reconcile with what people think their risk tolerance is, because they always think it's higher until they feel the burn, right? I mean, that's just how it is. So look, I think you go through enough of these sort of crises, you do understand that that they happen. They happen more frequently than people anticipate. They happen at really inconvenient times, and that's where, especially when you sort of talk about the paradigm of equities being a solution for everyone. I think thinking back to the old sort of Phenometrica type models and stuff like that, where you'd have someone with 300 that said, "Look, I want to retire on 1 mil, and I've only got 7 or 8 years to do it," and the program draws a straight line and tells you to be invested 100% in growth assets, right? But you've got someone that's in their 50s or 60s and that can't take the hit, that can't take the negative numbers. So that maths never contemplated what would it mean to you if it went to nothing. The qualitative questions supported the numeric calculation, but again, people find it really, really hard to conceptualize the downside, especially in hot markets, and they certainly have a difficulty in appreciating the opportunity when the opposite's true, right?
Yeah, and in fact, the Wall Street Journal, I think it was the Wall Street Journal, they published a chart which showed, I think in 20 years ago or 30 years ago, what the composition of an investor's portfolio would look like in order to achieve like a 7 or 8% rate of return. And it was basically a mix of bonds and stocks. That's all you needed to have. And gradually now, they did one in the middle, and then there was one in today's market in 2021. And in order to achieve that type of return, you not only need to have bonds and stocks, but you need to have private equity. You got to have some venture capital. You got to have this and you got to have that. And the composition of one's portfolio is far more complex than what it used to be, even 10 years ago, in order to achieve that same rate of return. And what effectively happened is your risk profile has gone up in order to achieve that same rate of return. So, mate, you're absolutely right. Interesting times. Markets continue to do what they do. I don't think we should be surprised at that. I think the recency bias of human beings says that because we've had a relatively smooth and stable ride for the last 10 years, people expect that to be the norm and expect that to continue for the next 10 years, which is, to your point, everything's good and well. And I think Mike Tyson said it, you've got a plan until you get punched in the face. And maybe this might be the left hook jab that a lot of investors needed to kind of wake up and just put things into perspective. Andrew, good chatting to you, man. Thanks for joining me today.
No worries at all. Anytime.